webinar. Thank you guys all for joining. My name is Dulce Martinez. I lead business development efforts for Stradling. We are a full-service corporate law firm with 10 offices west of the Rockies, and we're very pleased to present this webinar today on practical advice regarding forgiveness and update on recent changes in the Paycheck Protection Program. We are thrilled that we were able to have our friend Rick Hotz join us, so thank you, Rick. And on the Stradling side, we have our resident expert, Amit Singh, who's one of the shareholders in our corporate practice group that's going to be available to answer any questions as well. We appreciate all of you taking time out of your day to be with us today. And we know that there are a lot of questions that are going to be filtering in. This is a really important topic to many of you and all of you that are on the call. I would encourage you to leverage the Q&A box that should be at the bottom of your screen as an attendee and as a participant. Amit and Rick are going to go through the presentation today, and I think that you'll find that they'll answer a lot of your questions organically as they run through the presentation. So please be patient as they address all of the topics that they'll be sharing with you today, and then we'll be addressing questions at the end of the session. So please, again, use the Q&A box to submit any questions as they come up for you, and hopefully we'll be able to organically address any of those, but happy to answer as many of those towards the end. We've reserved about 15 minutes to comb through questions. And one thing that we'll just mention is that we'll be sure to follow up and provide the slides with you today that we've prepared, and also share contact information. So if you have more in-depth questions, or you would like to ask either of our panelists any of the questions that you might have, you know, we'll be sure that you're able to connect with those folks one-on-one. So with that, thank you so much. We'll kick off our session today with Amit Singh.
Hi, everybody. Nice to meet you. So I'm Amit Singh. I've been practicing as a corporate lawyer for over 20 years. I'm a corporate governance and business transactions expert with a particular emphasis on representing tech and life sciences companies, acting as outside general counsel, and most of my deals end up being venture and M&A transactions. Rick, you want to go ahead and introduce yourself?
Hi, my name is Rick Hotz. I'm a partner at Considine. I've been here about 22 years. I'm a tax partner with the firm. I specialize in both business and individual tax planning and tax preparation work, and any other type of tax compliance work. So I thought we'd start today by kind of a brief overview of what we're going to cover. We're going to go through a background of the PPP loans and the CARES Act that established that loan program, as well as the recent legislative changes by Congress. As many of you may be aware, there was already a bill passed last Friday that amended the CARES Act. This is one of, boy, a lot of changes we've had since the PPP loan program started over a couple of months ago. Then we're going to cover eligibility requirements to get the loan. Once you've gotten the loan and you want to apply for forgiveness, how and when you apply for forgiveness. We'll go through the qualifying expenses that you can count towards the PPP loans, the basis of accounting for costs within the period for those loans, the thresholds for forgiveness and repayment. Then we're going to discuss documentation requirements. Amit's going to discuss the audit risk and the liabilities and safe harbors for forgiveness, as well as going through some employment issues related to laying off employees and employees that won't return to work. And finally, we're going to do some Q&A. We'll get in as much as we can. I know this is going to be somewhat like drinking through a fire hose. There's a lot of information here, so we will try to double back into areas that we have questions on. And again, we're recording this, and so we'll disseminate it to everybody so that they can look at it again as needed.
Great. Thanks, Rick. Hey, just a quick plug for Rick. So I've worked with Rick for probably 12 years on many clients and very complicated transactions. So Rick is definitely a very smart guy, very responsive. So any folks who already have Rick as their accountant are very lucky, and anybody else should probably consider it. So the Paycheck Protection Program. So it's part of the $2 trillion Coronavirus Aid, Relief, and Economic Securities Act, the CARES Act. It's administered by the SBA. And as Rick mentioned, it was amended just on June 4th by the Paycheck Protection Flexibility Act. So the key terms, basically the idea is this is a great deal. If you can get it, this is a great deal. You can borrow up to 2.5 times your average monthly payroll for the covered period, up to $10 million. There's no personal guarantee required, no collateral. The interest rate is 1%. There's up to, it can be 100% forgivable if it's all the proceeds are used in the right ratios for permitted purposes. And the maturity date originally was 2 years, but now it's been extended to 5 years for loans that were incurred after June 4th. And anything before that, the borrower and lender can agree to extend it to 5 years. To be eligible, the business had to have been around since 2015 and had no more than the greater of 500 employees, or if it falls under different categories, these NAICS codes, then different calculations apply. For example, hospitals and restaurants, it's 500 employees by location rather than overall. Biotech companies and semiconductor manufacturers have their own employee thresholds. But there's also an alternative, even if you're over those thresholds based on net worth. So if together with your affiliates, and we'll talk about affiliates, the maximum tangible net worth of the business is not more than 15 million, and the average net income after taxes of the business for the first 2 fiscal years before the date of the application isn't more than 5 million, then you could also qualify. So affiliation rules. So the head count and those sort of net worth and income requirements, those apply not only to the business in question, but also to its affiliates. So the head count and those numbers apply to, as far as head count goes, it applies to not only applicants' employees, but those of its affiliates. So what is affiliation? It really revolves around control. So majority owner is automatically an affiliate. And a minority owner can be deemed an affiliate if either it can block a quorum of its stockholders or directors, or if it can veto sort of day-to-day operational issues as opposed to more extraordinary actions. Day-to-day operational issues would be hiring and firing officers, amending lease agreements, paying dividends, things that the SBA in the past has considered to be more operational. We had situations where we had clients that were venture-backed and they were afraid that the affiliation rules would cause the employees of all the portfolio companies of the venture funds to be counted in this calculation. And so we went to those funds and asked them if they'd be willing to ratchet back their, what we call protective provisions, these abilities to veto these actions so that it fits narrowly within this. And for the most part, they were willing to do so because obviously this is something that benefits them because it's non-dilutive capital. Rick, you want to talk about applying for forgiveness?
Yeah, so most of you, I imagine, have your loans by now and you're looking for forgiveness. And so I thought we'd start with how are we going to get forgiveness when we're ready for it? You're going to apply through your lender, first of all. This is an SBA guaranteed loan, but it's not an SBA direct loan. So you'll go through your bank to apply. You'll apply using the SBA form 3805 or the lender equivalent of that. I put a caution here. They already released the first draft of that application on May 20th. I'm sure a lot of you have seen it and read through it. You might as well throw that away at this point. The amendment to the CARES Act that passed last Friday changed so many things that we'll definitely be seeing a new form at some point and maybe multiple versions. When do you apply? You have 10 months from the earlier of December 31st, 2020, or 24 weeks after the loan is funded to apply for forgiveness. Now, so you have plenty of time to apply. As we're going to get to, the amendment to the CARES Act last week gives borrowers a choice to use either the original 8-week measurement period for incurring costs or a new 24-week period. We'll get into, there's some strategy as to which one you want to select, and it's not always the same choice for every business. It'll vary. So you have a lot of time to decide whether you're going to take that 8-week or 24-week period. So you can you could shoot for the 8-week period and wait. And since you have this 10-month window to apply, If it doesn't work out for you, then you can go for the 24-week. The lender has 60 days from the receipt of the application to issue a decision to the SBA. So you apply to the bank, they turn around and forward basically their recommendation to the SBA. The SBA then has 90 days to remit the loan forgiveness to the lender. So they're basically going to pay off your loan from the SBA. If you have an EIDL loan advance, which not everybody does, so an EIDL loan is a separate SBA direct loan that some of you may have applied for. The advance amount, which was up to $10,000 of that loan, is forgivable, but it is not forgivable if you also have a PPP loan. So what they'll do is they'll end up rolling the advance amount from that loan into the PPP loan, but that amount will not be forgiven. It will stay as a loan. Any amount not forgiven is repayable over 5 years now. Well, originally this was a 2-year repayment period. The amendment to the CARES Act last week changed that to 5 years. However, loans that were originated before last Friday's amendment, which is probably most of your companies have loans that originated before then, it's technically still a 2-year payback, but the banks may be allowed to change that to a 5-year repayment term. I don't know how the banks are going to handle that. I don't know how amenable they're going to be to that, but the CARES Act gives them the choice if the loan was originated before June 5th. If it's originated after June 5th, it's a 5-year loan. Payments are deferred until loan forgiveness occurs or 10 months after the end of the covered period, whichever comes first. So you have some time before they start. We'll get into what is this covered period. So the covered period is basically that 8-week period that's now a 24-week period you've been hearing so much about. It's the period for which you can incur or pay eligible costs for loan forgiveness. It's also used in calculating limits on loan forgiveness, and we'll get into that with the full-time equivalent rules. It starts on the date you received your PPP loan funds. So again, that's the date you received your money, not the date you signed your loan docs, but the date you got the cash, the date it hit your account. Borrowers who received funding prior to last Friday can choose between this 8 or 24-week covered period. Anybody who receives their loan proceeds after that date has the 24-week covered period. And again, so you get to choose. So I would imagine most of you had your loans before last Friday. So you're going to get to choose whichever method is best for you, the 8 or the 24-week period. For payroll purposes, there's another period. This gets complicated. There's something called an alternative payroll covered period. This only applies if you have a biweekly or weekly payroll cycle. So that's if you pay every other Friday. Now, most of my clients have semi-monthly payroll cycles. So they have one payroll period that goes the 1st through the 15th of the month, another one that goes the 16th through the end of the month. If that's your payroll cycle, the alternative payroll covered period is not an option for you. If you do choose the alternative payroll covered period, which I do suggest you do, I think it's almost always going to be better if you are a biweekly payroll company. That period begins on the first day of the next payroll cycle that follows the date you received your PPP loans. So the start of that for that alternative period will line up perfectly with the start of your next payroll. Again, this only applies to payroll costs. It doesn't apply to the other costs such as rent and utilities, which we'll get to later. So what expenses qualify for loan forgiveness during this covered period? So I break them into 2 buckets, payroll costs and non-payroll costs. Payroll costs include wages is the biggest number. This is gross wages capped at $100,000 per employee, prorated for the covered period. So this is prorated for the covered period. So under the old 8-week rules, that equates to $15,385 is the maximum comp for any employee for an includable wage in an 8-week period. One of the biggest benefits to last week's bill and the 24-week period is that you are now prorating this $100,000 cap over 24 weeks instead of 8, which now raises it to $46,153 for a $100,000 payroll. So this is big for a lot of my clients, particularly that are these small S corporations. Maybe the shareholder is the only employee, and so it was difficult to get over the payroll thresholds with just 1 or 2 employees. Well, now what you thought you were going to cap at 15 may be capped at 46 for you if you switch to the 24-week cycle. So for a lot of those really small companies, I think the 24-week period is going to be better for that reason. Owner salary is capped at the lesser of $100,000 or 2019 prorated wages. So there's a further cap of whatever you took last year, prorated for the covered period. Employer contributions to employee health insurance also counts as a payroll cost, as well as employer contributions to employee retirement accounts. It's just as vague as that. They have not given us any more detail as to what qualifies or doesn't qualify as an employer contribution to a retirement account. So for right now, I think any employer contribution qualifies. That includes a 2019 contribution that hasn't been funded. So if you haven't funded your profit sharing contribution for 2019 or a defined benefit plan contribution, as of now, and the rules are constantly changing, I believe that anything you fund for your employees during the covered period will qualify. So that is another suggestion for people that are having a hard time hitting the payroll thresholds. If you haven't funded your 19 pension, I would do that during your covered period. We actually know that there is some kind of a cap on retirement contribution for owners, but it's really vague as to what that is. The regulations that came out two to 3 weeks ago on this are very poorly written, and it was something that came from the SBA, not Congress. And right now, I think it's possible to interpret it one of three ways, that owner retirement contributions could be capped at 2019 levels. It's reasonable to think that you could roll it into the salary numbers and it's subject to the $100,000 cap for all of it. And it's also reasonable to believe that it's not includable at all for owners. So we're still waiting on guidance. That's probably the number one thing I'm looking forward to getting more guidance on. And the final item, which is very small, probably not anything you should be concerned about, is state and local employer payroll taxes. That would be your state unemployment insurance. I doubt that's much of anything for those of you listening, so I wouldn't spend too much time in that area. So furthermore, on qualifying expenses, borrowers are generally eligible for forgiveness for payroll costs paid and payroll costs incurred during the covered period. So when the SBA released these rules, this is very business friendly. So you can get credit for a cost, and this goes for payroll and non-payroll costs, if you pay it during this covered period, or you incur it during the covered period. So payroll costs are considered paid when you pay it. So that's the date that the direct deposit hits your employee's originates and hits the employee's accounts. And payroll costs are incurred on the date that the employee's pay is earned. So this is why you would definitely take the alternative payroll covered period if you can. So because the period would align with the start of a payroll period, and if you're using the 8-week cycle, you're going to get 4 complete 2-week cycles in your 8-week period that are incurred. The last one of those is going to be paid technically after the alternative period ends, but it still counts because it was incurred during the covered period. Conversely, on the front end, here's the advantage. You probably will have a paycheck date that will get paid, I'd say 2, 3, 4 days after the start of the alternative period, which is really for the payroll period that was entirely preceded the alternative period. And so essentially you're going to get 2 more weeks in. So in an 8-week covered period, you're going to get 10 weeks of payroll. Even if you're not on the alternative cycle because it can't apply to you, you're on the regular covered period that starts when your loan originated, you're still likely going to get more than 8 weeks because of this rule. You're going to get somewhere between 8 and 10, depending upon when your pay dates just happen to fall in relation to when your loan was funded. Non-payroll costs. This includes interest payments on any business mortgage obligations on real or personal property incurred before February 15th. So this is just the interest on, there could be the mortgage on your factory, could be equipment financing or whatnot. Rent or lease payments on real or personal property for leases in force before February 15th, 2020. So again, this is the rent on your facilities or your office space or your equipment, your computers, whatever it may be. I personally think I would put it in this rent bucket regardless if you count it as a capital lease or an operating lease on your books. There's not a whole lot of guidance from the SBA, but my gut feeling is if it refers to it as a rental or lease payment in the agreement, you should put it into this bucket. And finally, utility payments for gas, electricity, water, telephone, internet, or transportation qualify. So again, telephone and internet can be big for a lot of large offices, so that's one to pay attention to. I have to be honest, I really don't know what they refer to by transportation. I'm wondering if fuel costs perhaps qualify, but that's another area that we haven't really received any further guidance on. And just like payroll costs, an eligible non-payroll cost must be paid during the covered period or incurred during the covered period and paid on or before the next billing date. So again, you get to take what was incurred and what was paid as long as you don't double dip on the same bill. So I have some owners who they may run a restaurant or a bar who told me, hey, Rick, I'm behind 2 months on my rent and utilities when this started. And they use the proceeds to pay those back obligations as well as to pay the current obligations. They may end up essentially having 3 or 4 months of rent and utilities in their non-payroll costs because they paid back costs and incurred new costs that they then paid. Limits on loan forgiveness. So now if you think that it's been complicated at this point, you haven't seen anything yet. So obviously you have to spend your loan proceeds on the qualifying expenses we just discussed to get loan forgiveness. So if you had a $100,000 loan and you only incurred $90,000 of eligible costs, then you're only gonna have $90,000 of forgiveness at the maximum. And that can be further reduced by these other issues we'll discuss. Another big change in last week's bill is at least 60% of the loan proceeds must be spent on payroll costs to receive any forgiveness. This used to be a 75% threshold, and it used to be a sliding threshold. That changed last week. It's now 60%. So 60% of your loan forgiveness, of your loan proceeds, your loan proceeds must be spent on those payroll bucket items we talked about, which is the wages, health insurance, and retirement costs. If you end up at 58%, you get no forgiveness.
Rick, that I don't know if you saw the guidance from the SBA. It might have been on Monday, so it's very recent. You may have missed it, but actually you're absolutely right that that's what the amendment said. Mm-hmm. But then the SBA said, you know what? That's not what we intended. We're not trying to sort of go backwards. They did go back to that sliding scale you were talking about. They gave an example of you borrow $100,000, you spend $54,000, which is 90%, or sorry, 90% of 60% of the 100,000 on salaries, then you get 90,000. So 90% of your $100,000 loan would actually be forgiven. So luckily they ratcheted that back to the sliding scale you were talking about.
Yeah, there's been some debate with that because if you read the bill to me seemed very clear that it was sort of a cliff 60% threshold. Right. But then soon after they passed it, a lot of senators said, well, that wasn't really what we meant. And Steve Mnuchin came out with some comments saying, well, that's not what they meant. So there's some questions about whether or not what the SBA is trying to do actually is legal, whether they can override Congress. I think this is an area we're going to get further guidance on, and I wouldn't be surprised if we get another congressional bill to clarify it because it's such a big issue. So another thing to watch for. Personally, I would probably treat it like it's a cliff and get over that 60% threshold just in case, but it's definitely an item that's going back and forth. The next issue is a pay rate issue. Loan forgiveness is limited if any employee during the covered period or the alternative period, if you select it, is paid an hourly or salary rate that is less than 75% of the rate they were paid in the first quarter of 2020. I don't think this is going to be a problem for really anybody, again, because it's talking about rate. So it's the hourly rate or the salary rate. You could have cut their hours and therefore paid them less, but as long as the rate didn't go down by more than 25%, you're not going to have a limit on loan forgiveness due to this piece here. So this is the first step. The next one is what's going to trip most people up, I think. So the next limit on loan forgiveness is that it is proportionally reduced by any reduction in full-time equivalent employees during the covered period or the alternative period if it's selected when compared to the base period. So the first thing is, what is an FTE? It's a full-time equivalent employee. It's measured on a 40-hour work week. So if I work 40 hours a week on average during a period, I'm a 1 for FTE counting. If I work 20 hours a week during a period, I'm a 0.5 FTE. When calculating this for any of the periods, the instructions allow you to round the FTEs to the nearest tenth, or just to use any one that's less than a full FTE as a half. So that may work in your favor, just kind of depends on how the math works. And there's definitely a simplicity that can go to just using the half method, but that's something that's in the instructions for you. And if you think it benefits you one way or the other, take a look at that. Now, what is the base period that we're comparing the covered period to? You get to choose between either January 1st of this year through February 29th of this year, or February 15th through June 30th of 2019. Where they got these dates from, I have no idea. So you'll want to look at whichever one of those periods you had fewer FTEs, you'd want to go with, because that sets a lower bar for you to clear. So you're going to compare the FTEs during the covered period on average to one of these base periods. If the covered period is lower, you will proportionally lose loan forgiveness. So if I have a $100,000 loan and my FTEs went down by 20%, 20% of my loan will have to be repaid. I think this is the biggest limitation on loan forgiveness that will trip up companies. And this is the reason why you may want to stick with the 8-week period rather than the 24-week period. A lot of my clients are saying, well, we have 24 weeks. Why wouldn't we want to take that? Well, 24 weeks is a long time to keep your full-time equivalents up. And remember, just having your FTEs drop by 1 could trigger a limitation on loan forgiveness, especially for a small company. If you have 5 employees and business slows down in the second half of the year and you go from 5 to 4, well, now you have a 20% recapture in your loan. So if you've been pushing through this 8-week period and you have total loan forgiveness because you've kept your FTEs up, you definitely want to use the 8-week. But if, say, you're at 90% forgiveness through the 8-week period, you, going back to our earlier slide, you have 10 months to file this application for forgiveness. So you can wait and see how the 24-week period plays out for you. And if that's better, go with that. Or if 3 or 4 months from now, your business is weaning a bit and you can't keep your full-time equivalents up and you realize I can't beat what I did in the 8-week period, then you can go ahead and file then using the 8-week period. So you're going to get to choose.
So now we're talking a little bit about the certifications, both the ones you had to make when you were applying for the loan and then ones that you have to make when applying for forgiveness. So when applying for the loan, you have to use the funds for permitted purposes for the covered period. And Rick went into detail about those. And you also have to say that you don't have a duplicative action pending. But the biggest issue is that you have to certify that the loan is necessary in light of current economic uncertainty to support the applicant's ongoing operations. And that created a lot of concern for our clients because they're worried about their liability and what this all means. And the SBA came out with guidance saying that necessity is determined in light of the applicant's current business activity and ability to access other sources of liquidity sufficient to support its ongoing operations in a manner that's not significantly detrimental to the business. But what does that mean? So then they went on to say, well, an example is that it'd be unlikely that a public company with a large market cap and access to the public markets would be able to make this certification in good faith. But a smaller company, who knows? So they gave additional safe harbors. They had this question 46 that they answered and said that if a borrower received less than a $2 million loan, they will have deemed to have made that required certification as far as necessity in good faith. So it provides a lot of more comfort to folks. But even with that, clients were very concerned. Well, wait a second, I understand, that maybe I've got this benefit that they're gonna defer to me and deem me to have made a good faith. But nonetheless, the risk to me is that there's criminal liability. So these things have actual criminal liability if this wasn't made in good faith. And so the SBA said that if it determines that a borrower lacked an adequate basis for the required certification concerning necessity, and this applies whether you had a less than $2 million loan or more than $2 million loan, it will seek repayment of the loan rather than try to seek criminal liability or something like that. So it provided folks with a lot more comfort. Now, in order to protect yourself, you want to make sure that you're not really commingling these funds with other funds. The ideal is to have a separate bank account and pay the funds for the permitted purposes for the covered period out of that account. May not always be practical and may not be what you've done, but ideally that's how it would work. If you receive less than $2 million, you won't be audited by the SBA. And if you receive more than $2 million, you will be audited. So at least you have that sort of bright line. But nonetheless, even if you receive less than $2 million, that doesn't mean it's risk-free. So you could still have a whistleblower saying, hey, this company actually didn't need this money, it didn't make those certifications in good faith. And so that could trigger an audit or other inquiry. And in any case, you're always liable for fraud. So you still want to, even if you've not done it yet, go back and do a ratifying board resolution, having some kind of document by the CFO or some other folks that talks about, well, what was the thinking at the time? Talk about your revenue, cash flow reductions, AR issues you experienced, loss of customers, what you did with respect to your employees, what cash was available, what other sources of financing did you have? Were there lines of credit that were still open to you? Or maybe you weren't able to tap those because you couldn't say a material adverse effect hasn't occurred on your business to be able to tap those lines. Did existing investors say, hey, we've got $5 million we'd be willing to infuse in the company? So what were the other opportunities you had for capital? You would obviously want to say that we didn't have any and there was this necessity to get this additional capital. So then on the forgiveness application, borrowers have to make additional certifications. One is that they use the proceeds for the permitted purposes during the covered period within the prescribed limits that Rick went into detail on. And it requires an acknowledgement by the buyer that if it used the proceeds improperly, like buying boats and other things that don't fall into those categories of rent and payroll and things like that, that there could be civil and even criminal penalties. And also that the borrower has verified all payroll and non-payroll expenses for which it's requesting forgiveness. Before we got this application for forgiveness, we were very concerned that they might require you to recertify that the funds actually were necessary. And 2020 hindsight, or hindsight is always 2020, as they say. So it may be the case that it turns out things actually weren't that bad. You were wrong, even though in good faith at that time you believed that you did need these funds and you were going to have to recertify that. Luckily, the application for forgiveness does not require recertification. So you are measured at the time of applying for the loan rather than at the time of forgiveness. So Rick mentioned that, that the forgiveness amount will be reduced for employee reductions. And that created a lot of headaches for our clients because there may be reasons beyond their control that they weren't able to get headcount back. Maybe employees weren't willing to come back and things like that. So they so they said, okay, well, here's a couple safe harbors. If you reduce your headcount before the end of the year, if you get the headcount back, reduce those eliminations back by the end of the year, they won't be counted against you. And if the wages are caught up by the end of the year, you also won't experience those reductions. And you also won't be penalized for reductions in headcount if you can show that you're unable to rehire employees. And it often happened because employees said, hey, I'm making more money sitting at home than I was working for you. Or maybe it's not devious like that, but rather I've got kids at home and they can't go to daycare, or many legitimate reasons. And then you're not able to hire similarly qualified employees. Well, if those two things apply, then you won't be penalized. And also, you have businesses like gyms that are just starting, like in San Diego, just starting open on Friday, and other businesses that because of the maintenance and sanitation requirements, the social distancing, or other rules or guidance by the HHS and other agencies, weren't able to reopen or weren't able to get back to the same employee levels, well, you won't be penalized for that as well, as long as you can show that it was related to these requirements. But if you are going to rely on the inability to bring back employees, or if you had to fire somebody for cause, you want to be very careful and document it well. What you want to do is you want to send a written offer back to the employee saying, hey, things are back, we want to bring you back. Your salary, hours, all that is going to be the same, and have it documented that they rejected that. And then you have to notify the unemployment office that, hey, they rejected this. And it may, in theory, make you unpopular, but obviously you've got to run your business, and it doesn't necessarily mean they won't be entitled to unemployment. So they have other protections because maybe they have to take home care of their kids or their parents, or maybe it's too dangerous for them to come to the workplace because of their home situation. So you just want to document that, and it's not necessarily a killer for the employee. And if you fire somebody for cause, that also can be okay. But if you terminate for cause, you have to have some objective basis. So you should document the misconduct or poor performance and things like that. So now I think we've kind of gone through the basic presentation. I know that there are some questions on the Q&A. Dulce, I think you were going to monitor those questions. I see some here.
That's exactly right. So if you guys have any questions, again, now is a great time to chat those through to the Q&A box via the window at the bottom of your screen, and we will go through some of these now. So Rick and Amit, thank you. That was great. I think you guys should be able to see the Q&A box as well, but I'm just going to start going down the list, and hopefully we can address some of these specific questions that folks had during the session. So we'll look at the first question. It looks as though there was an organization that accepted a pretty substantial amount of money. They don't plan to rehire all of their furloughed employees as a result of their business activity decreasing. So they're looking to maximize the forgiveness amount, and we're wondering if you had any specific strategies to address that. Now, that question came in earlier. I'm not sure if you feel like you adequately answered that, but wanted to just pose that if there was any other nuances that you thought you'd add.
Well,
yeah, I'd go back to the safe harbor, that if you can document that it was because that you weren't able to get back to the same level of business because you're complying with the social distancing requirements or customer safety requirements and things like that, that would be very helpful. Showing, or that if you can follow one of these other categories because you were unable to hire. But I think as far as the strategy related to the business not receiving the same activity, if you can point to the compliance with the guidance and requirements of HHS and the other agencies related to protecting people due to the COVID crisis from getting the virus, that would be very helpful to your case.
Great, that's very helpful, thank you. When we're talking about qualifying income, I know that every industry has its nuances, so curious about how tips factor into that calculation for a restaurant owner.
Tips count as a wage off of whatever the reported tips were on their payroll. So if you weren't reporting your tips correctly, I guess that would help you. But that's what they're going to look at. They're going to look at the tips you ran through payroll for both the covered period and the base period. It obviously can be, they just look at the total wage. So it's not like the tips have to be equal and the base wage has to be equal between the covered period and the base period. Just in total, they're looking at both of them.
Great. And then another follow-up question on the restaurant front, just to come full circle on that, is in terms of qualification, is it appropriate for some restaurant employees to be considered seasonal workers? Looks like depending on the time of year, like summer, Thanksgiving, New Year's, et cetera, these folks see a spike. So curious if seasonality applies to restaurant servers.
I'm not aware that it appears that it does apply to the restaurants. There are special rules for seasonal businesses that I'm not going to get into because they're a little involved. One of them requires you to use the 2019 FTE benchmark rather than the 2020 period. But for restaurants, no, even though they are seasonal, I realize I don't think they're going to meet the seasonality requirements. I think that that's one of the interesting things about the new law that I wasn't pleased with was that the safe harbor for bringing your employees back. So this is for businesses who cut their head count during the pandemic, that the old rule said, well, if you restore your FTEs to the February 15th level by June 30th, we would just basically throw the FTE limitation out the window. And that was great. Well, now they've moved that June 30th date to December 31st. Well, for some businesses, I don't think that's a good thing because some restaurants, seasonality wise, just aren't that busy at the end of the year and their headcount might be lower. There's other types of businesses that are also seasonal around the holidays and slow down. So I'm kind of curious to see if that changes, if Congress changes that as we move along.
Got it. Thank you for that. Now, when we think about, folks that are not returning after the dates in question, are these guys still covered? We have people, we had a question for somebody that was on leave that didn't return to work. And so curious if they are eligible or considered a covered employee.
Well, if there's somebody who wasn't willing to come back, then you would not be penalized for it. But as far as if there were, I guess if they're on leave like vacation, I frankly don't know how that affects it. Do you know, Rick?
No, not necessarily. Another question I had in that realm was people out on maternity leave that their headcount went down because they had an employee leave who was in the base period and out on maternity leave. It's not totally clear. I would guess that would maybe fall into the safe harbor as someone who willingly left. This is an area I think we want to see more guidance from the SBA on. If you looked at the first version, the only version for that matter that we have of the forgiveness application, they have safe harbors for employees that left and wouldn't come back. Those definitions, that verbiage, it doesn't really match up with the new bill that passed Congress last week. The congressional bill, which of course that's the law and that's the overriding, doctrine that we need to follow, that for the first time gave safe harbors for employees who left and didn't come back. And it doesn't match up with what the SBA was saying. So I'm curious to see if the SBA is just going to strike what they had altogether and just go with what's in the bill, or if they're going to somehow try to mesh them together. So I think this is one of the areas of the legislation that unfortunately we don't have perfect guidance on now for some of these employees that, well, they left, but they left for, not specifically the reason that's stated in the safe harbors. How do we deal with that?
Got it. Thank you. And then as we're thinking about types of employees, guys, are there any negative implications for hiring family members like a spouse or other relatives?
Not explicitly, although there are those caps on owner compensation. I believe just under the attribution rules that a spouse would be considered an owner. So to me, I think they're subject to the owner caps. So you'd have to watch out for that. I don't see anything that explicitly says that your kids, your adult children or your nephews or whatever can't work in the business and get paid. I don't think that that's a problem as long as they're a bona fide employee providing a service.
Great, thank you. Now, again, on the FTE designation, if somebody submits a resignation to move, I know we were just talking about, other types of leave, but if there's a leave related specifically to COVID or they feel unsafe to return due to COVID specifically, is there any specific guidance around that?
Yeah, you would still offer them the ability to come back, and they would say, well, I can't come back for this reason, you'd still notify the unemployment office that this person doesn't want to come back, and then you theoretically shouldn't be pinged for that. And again, I think that they wouldn't necessarily miss out on unemployment insurance either. So you wouldn't necessarily be hurting that employee if they have a legitimate reason for not coming back.
Got it. And then just to clarify, do we have until the end of the 24-week period to reach that FTE number? Is it the 24, just to clarify for folks, it's the 24-week period?
Yeah, it's an average, which is why you have to, if you're going to go with the 24-week period, you have to wait until the end of the 24 weeks to apply for forgiveness. A lot of people, I think, are under the belief that, okay, I spent all the money by week 10, I can go apply now. But in order to pass that test, you have to show the bank that you kept your full-time equivalents up over the base period amount for the full 24 weeks. It's basically an average of the 24 weeks. So you'd have to complete the whole time period in order to apply.
Got it. And to the 24-week note, if you're extinguishing your funds in 10 to 12 weeks, can you apply for forgiveness immediately, or do you have to wait until the end of that period?
You'd have to wait till the end of the 24 weeks. The only way, if you're waiting to decide if the 8 versus the 24 is better and the 8 ends up being better, well, then you could apply because the 8 weeks would be done. You could provide your documentation for the full-time equivalence test because that's based on the 8-week period in your case. But if you're going for the 24-week period, you have to wait for the full 24 weeks to be done because, again, your head count could drop.
Got it. And then once you get your forgiveness, is there any additional penalty if you're repaying that balance immediately?
No, there's no prepayment penalty. The loans accrue interest at 1%. They haven't explicitly said it, but based on the verbiage in the law, it appears that the interest is not going to be forgiven. So that is, I guess, one very small downside to waiting is that it's accruing interest, but it's only at 1%. But there's no prepayment penalty.
Got it. I'm just looking through our questions here. As it relates to HRA contributions, from an employer, would those qualify as health insurance expenses in this case?
Yes, if you have a self-insured plan, and so part of it is a health reimbursement arrangement, that does qualify.
Got it. And I think we may have touched on this already. But again, do you need to have 100% of your full-time employees rehired by the end of December, or your part-time employees also? I know we've talked a lot about full-time employees. Now questions around part-time.
You have to have your FTEs for the payroll period, that the week, I should say, that includes December 31st. Because again, there's no such thing as really what is your FTEs on a date, because FTEs are based on a 40-hour work week. So you have to look at a 40-hour period. So I believe the way they've described it is you look at the 40-hour period that includes December 31st, 2020, and the total FTEs have to clear that base period amount. It could be a different mix of them. So I could have had 6 FTEs in the base period that was really comprised of 12 people that worked 20 hours a week. And I could have replaced them with 6 full-time people. So now I have 6 instead of 12 employees, but because they're full-time, I have the same number of FTEs and I would have met the threshold. So that's how you measure it. So you just got to meet the FTEs, not necessarily a head count.
Got it. That makes sense. Thank you. Now, a question from a sole proprietor. Does the extended 24-week covered period apply to the Schedule C owner comp limitation for forgiveness as well? The question is if that would effectively make 100% of the loan forgivable for sole proprietors.
Yes, absolutely. That's a great question. Yes, the answer to that question is yes. If you are Schedule C, I think you almost certainly want to go with the 24-week period. Most Schedule Cs don't have employees. They're just self-employed people. If you had employees, then the payroll plus your prorated Schedule C income are both considered payroll costs. But if you don't have employees, under the old rules, you were stuck to 850 seconds of line 31 on your Schedule C from last year. And so that was at best going to be, 70% of your loan amount. And a lot of Schedule C people don't have rent. They may not have much utilities. So it was hard to get full loan forgiveness. This is a huge lifesaver for those people, because you definitely, if you're in that bucket, want to go with the 24-week, because now you're going to get 24 50 seconds of last year's Schedule C income, and that's going to get you over 100% spent. And as far as that, another interesting question is, could a Schedule C person apply early, since the FTE rules kind of don't apply to them because it's just them? I would think they could, but we don't have any guidance on that yet. So I see another interesting question. I see another interesting question on the board. I thought I'd just jump into real quick, which is, what is the tax consequences of the funds received? So that's an interesting question. And so as of today, what the law is that the CARES Act explicitly said that the forgivable loan amount is not taxable income to the borrower. However, the IRS had to come in and be a bunch of party poopers on that and remind us all that there is a long-standing rule in the Internal Revenue Code that says deductions that are directly allocable to non-taxable income are not deductible. So the IRS said, well, while it's not taxable revenue to you, the underlying payroll costs and rent and utilities, we don't think are deductible. So when you think about that, that's basically a wash, which equates to the same thing that would have happened if the loan proceeds were taxable in the first place. So if you had a $200,000 loan and that's forgiven, while that's not taxable, you lose $200,000 worth of deductions and you're right back to where you started. Now, some members of Congress had commented that they didn't realize that that rule was on the books in the Internal Revenue Code, and there's some question as to whether or not that technically applies to this. So I think there's a chance you could possibly see congressional legislation on this if they really want to make it the whole thing non-taxable, stating that you can deduct those costs and not report the income as taxable income. But in my 20 plus years of public accounting, I could tell you that if we get that bill, it's likely not to come until probably even after year end. So.
One interesting question is that somebody asked if your employee count was sufficient at the end of the 8-week period and you submitted your application, but before your application is approved, you do a massive layoff at week 12, then are you, basically do you get hit? I don't see why you would. What they're really trying to do is they're trying to make sure that you maintain the employment for the agreed period. You're not agreeing that you're never going to do a layoff. So it really just look at the covered period. You meet the requirements. It's kind of black and white. So luckily, what you do afterwards doesn't negatively affect you.
Yep.
We're coming up at 1:30, so I'm going to have a couple more questions and then we'll wrap up our session here. I know that there are some questions around qualification of union employee benefits. Do these count towards payroll expenses?
That's a good question. I can't recall specifically reading anything about that. However, I don't see why they would not qualify. Typically, I have some experience in the construction industry. Typically, the construction companies will remit those amounts to the union on typically a monthly basis, and they're stipulated as this amount is for pension, this amount is for healthcare benefits. I would think that would qualify. I'm not aware of anything now that says it wouldn't.
Great, thank you. And then just to clarify, do the loan payments themselves count towards forgiveness?
Do the loan payments themselves, well, you wouldn't have, I think they're referring to if you had like a mortgage on your property or on your equipment, you had a loan, it's only the interest payments you make that qualify as a non-payroll cost for loan forgiveness. The principal amount of the loan payments don't qualify.
Great, thank you. And then curious as well what the relationship between the PPP program and the EIDL program is, if there's any relationship between both.
Only in the fact, so the EIDLs, those are basically disaster assistance loans directly through the SBA. Those carry a 30-year term, I believe, and have a different interest rate as well, a little bit higher rate. The only way they interplay is that advance amount, if you have a PPP loan and an EIDL loan, that advance amount on the EIDL loan won't be forgiven because they won't allow you to have forgiveness under both types of loans. The way that they, like I said, the way that it reads now, it reads like the advance amount will roll into your PPP loan and go under that amortization rather than into the 30-year EIDL loan. I don't know if that's something they're going to change. And I don't know if it may make a difference if your EIDL loan is in excess of the advance amount. Some people only took the advance amount. Some people took, could have taken hundreds of thousands of dollars under that loan program. I don't know if they're going to treat them differently.
Got it. And I know that we still have quite a few questions in the queue, but we are right at a minute after 1:30, so I want to be respectful of everybody's time. I'll let Amit and Rick take a look at our Q&A if there's, maybe one more question that you think would be beneficial for the rest of the group to answer. But I know that we covered a lot of helpful territory here. And we're going to be sure to distribute all of the slides from today's session and a copy of the recording as well. We have everybody's emails via the registration link, so we'll be able to find you. I know that that was a question that came through a couple of times. But, Amit and Rick, we really appreciate your expertise here. I know that this is very confusing and very hard to sift through. So on behalf of all of our attendees, thank you so much for sharing your expertise and your time with everyone. If you want to give, maybe wrap it up, hear the Oscar music start to play.
No, I want to say thank you everyone for attending, and I want to add one quick thing. There's a huge caveat here. These rules will likely change again. So, stay in touch with Stradling and Considine. We're happy to give you all the advice you need, but we've had lots of changes so far, and there's no reason to believe they're not going to change this further.
Absolutely. Yeah, thanks a lot, Dulce, for setting this up, and Rick, thanks a lot for your sage advice. Great seeing everybody, and definitely feel free to reach out to Rick or myself if you have any additional questions. Obviously, Rick is the accounting expert, so the detailed questions on accounting would be very appropriate for Rick. And if you have any questions about selling your business and how these things apply, or your venture-backed and affiliation rules, all those things, or broader issues on liability, I'd be happy to answer those questions. Thanks, everybody.
And we'll be sure to continue to produce quality sessions like these to address many changes that we've seen in the program thus far and what we anticipate changing in the future. So we'll hope you'll join us for a future session as well. Thank you guys. Have a great day.